Buying calls and buying puts are two of the simplest option strategies that you can use, but they are the bread and butter if you want to multiply your returns in the stock market. Welcome back to Everything Options. My name is Greg, and today we're going to be talking about the simplest strategies that you can use buying calls and buying puts. So to break this video down for you, first we're going to talk about the basics behind these two strategies. After that, I'm going to take you through an example for each of them. And finally, at the end of this video, we're going to talk about the risks that come along with buying options. But before we get into that, if you learned anything out of this video, or if you just enjoy it, make sure to show some love, leave a like, and let's get into it.
Call options. Oh, my voice broke.
Call options can be one of the best ways that you can make money whenever you think that a stock is going to go up. For example, I bought this high max call and it's up by 28% this month when the stock itself is only up by 11%. So the call option I bought more than doubled the performance of the underlying stock. But the question is, how did I end up choosing this option? And the first thing you're going to do whenever you buy a call option is you need to set your expiration date. And you can think of this sort of like a timeline of when you think that the stock is going to go up. So for me, I chose an expiration date that is far, far out. That way I have plenty of time in order for the stock to go up. So my expiration date for this option was January 2023, which is next year. So I have over a year for this option to expire. Now you can choose whatever expiration date you want based on whatever time frame you think the stock is going to go up. So if you want to buy weekly options, you can do that. But personally, I don't buy any options with less than 60 days until the expiration. And the reason behind this is because over time, your options are going to lose value because of time decay. And in order to put that on your side, you want to have a longer expiration date because in the last about 60 days until the expiration, that's when you lose the most amount of time value. So the general rule of thumb here whenever you're buying options is to set your expiration date to at least 60 days out if you can afford to, and as far as you can afford to extend the expiration date after that. So for me, I could afford a 1 year out expiration with this stock in particular, but with other stocks I might have to go with 60 days because they can get a lot more expensive. And the amount that you end up paying for an option is going to be called premium. And this is just a fancy term for whatever the option is going to cost you. And this is made up in two parts. So you have intrinsic value, which is if the option is in the money. So for a call option, the stock needs to be above the strike price that you choose in order for the option to have any intrinsic value. And the reason behind this is because you can exercise your call option to buy 100 shares of the stock at your strike price and then sell it at the higher market price. So for example, if XYZ stock is trading at $11, but I bought a $10 call option, this option has $1 of intrinsic value to where I could buy 100 shares at $10, I could sell them at the market price of $11, and I make $100 of profit from that trade. But generally, you don't want to exercise the options before the expiration date because there is still extrinsic value. Now, extrinsic value is just time value, and this is going to depend on one, of course, the amount of time that's left in your option, and then two, how close the stock is to your strike price. If the stock is closer to your strike price, then the option is going to have more extrinsic value, and as it goes away to either out of the money or in the money, it's going to lose extrinsic value. And that brings us into how to choose your strike price. Now, however you choose your strike price is ultimately going to be up to you, but the way that I chose my strike price whenever it comes to this high max call was making sure that I had a super low break-even price. So I bought these call options for $4.70. The strike price is $7, so that means that my break-even is $7 plus a $4.70 that I paid for each contract, or a break even of $11.70. So that's how I ended up choosing my strike price. You can also choose it based on delta value, or the amount that your option changes for every dollar that the stock goes up or down. You can choose your strike price based on how much premium that you're going to pay for your option. There's a ton of different ways to choose your strike price. But once you've chosen your strike price, then it comes down to the amount of premium or the amount of money that you have to pay in order to open your option. And this is important because if you're wrong on your trade, you could lose the entire amount of premium that you put into it. So for example, if I bought a call option on XYZ with a $100 strike price and I paid $1,000 for it, if XYZ is below my $100 strike price on my expiration date, I'm going to lose out on that entire $1,000 that I put into the trade. Now we'll get into the risks of buying options later on and probably cover this again. But for now, let me show you actually how to buy a call option. It's super easy. So the first thing to do whenever you want to buy a call option is to find a stock that you think is going to go up. Now this is going to be up to you, whatever stock you choose, but I'm going to be choosing Himax. And the reason behind this is because they're going to have their earnings next month in early February, and I think that their earnings is probably going to announce some huge dividend payment. And because of this, they're going to create a lot of buying pressure for their stock, and ultimately it's going to send it up. So I'm going to go to the option chain for Himax, and I'm going to set my expiration date to June 17th. Now, earnings is supposed to be in February, but I'm giving myself plenty of time until the expiration after their earnings in order for one, Himax to go up, and two, so this option doesn't lose its intrinsic value so quickly as time passes. And I'm going to choose a strike price based on what price I think that Himax could be above by my expiration date. And the way that I'm going to do this is by looking at the break-even prices, and I think that Himax could be above a price of around $14. Now this $11 call has a break-even of $11 plus $3.25, or a break-even of $14.25, which is pretty close to my $14 mark that I'm looking for. So I'm going to buy this $11 call for $325. The cost for it is actually $330, so my break-even is $14.30. And if we look at this profit and loss graph, we can see that the expected amount of profit is going to be unlimited. And the reason behind this is because Himax stock has no cap on what it could potentially reach. It could go to infinity, potentially. Not realistically, but there's no cap to what the stock could reach. So maybe it's more like $16 by our expiration date. In this case, we would make a profit of $170. And the way that I calculated this was by taking the $16 price target that I have for the stock, subtracting my break even of $14.30 for a profit of $170. So if I'm right about this, I would make a profit of around 50% over the next about 6 months, which is pretty dang good if you ask me. But the problem is, if I'm wrong about this trade and if Himax goes down after their earnings like I'm not expecting, we could lose a lot of money. We could lose as much as we pay for this option, which again was $330. So say we bought 3 of these instead of just one of them, we could lose as much as $990 for this trade, which is a lot of money for me to lose. But again, if I'm right and Himax is at $16 by my expiration date, we make $170 per contract, which in total would be $510 of profit from a $990 investment. We'll see whether or not I'm right about this trade. I'd be willing to bet that I am, but that's just my opinion. And if I thought the stock could go down from where it's at right now, I could buy put options instead. So let's talk about those. Put options are a great way to bet against a stock and multiply your returns than if you were to short sell a stock. And most brokers for retail traders don't even allow you to short sell stocks. So this can be one of the few strategies you can use to bet against a company. Buying a put option is very similar to shorting a stock, since you're agreeing to sell 100 shares of the stock at your strike price. So you can kind of think of this like short selling 100 shares of the company, but not exactly. You're controlling those 100 shares and you're agreeing to sell them at your strike price, but you don't have to. And you can also close the option before the expiration date if you want to take profit or if you want to stop a loss. Now, put options work a lot like call options, where you first have to select your expiration date. And even for put options, I would err on the side of more time, because as time passes, you're going to lose the time value for that option. And since you're paying a debit in order to open the trade, that time value is going to eat away at your profits. So for put options and call options, I would suggest 60 days or more until the expiration date. That's just a general rule of thumb. You don't have to follow it, but I think that is best practice. Now, after we've chosen our expiration date, then we get to choose our strike price, just like with call options. But with call options, we're agreeing to buy 100 shares of the stock, but with put options, we're agreeing to sell 100 shares of the stock at our strike price. This means that ultimately we want the stock to be below our strike price on the expiration date. That way, the option has value and that option would be in the money. It would have intrinsic value to it. For example, if I have a put option with a $10 strike price and the stock is trading at $9, I could buy 100 shares of the stock at the $9 current price and then use my put option to sell the 100 shares at the $10 price. This means I would make $100 off of this trade, so this option has $100 of intrinsic value. But we also have to account for the extrinsic value or the time value before the expiration date. And the amount that you pay for your option in total is going to be called premium, and that is going to be the addition of both your intrinsic value for the option, if it's in the money, and then the extrinsic value for your option. And in order to calculate your break even, you would take the strike price for your option and then subtract the amount of premium or the amount total that you pay for each option. And if you want to be at a profit on the expiration date, you're going to need the option to be below your break-even price. And if it's above that, then you will take a loss. And if it's above your strike price, then you're going to lose all that you invested into these options. We'll go over the details for this in this next example. So for put options, you want to start with a stock that you think is going to go down. And for me, this is going to be Ford Motor Company. And the reason behind this is I think that they are a little bit overambitious with their electric vehicle goals, now doubling their production estimates for the Lightning when they haven't even delivered a single truck. So I see that as a major concern, whereas the markets are just loving it. So I'm going to buy a put option on Ford. I'm going to set my expiration date to June 17th, just like I did with the Himax call option. And I think that Ford could be below about $22 on my expiration date. So I'm going to find a put option with a break even of around $22. This 26 put is going for $410. So if we subtract the $410 from the $26 strike price, our break even for this would be $21.90. We can confirm that by looking at the break even right here of $21.90. So if we're right about this and somehow Ford ends up going to zero for whatever reason over the next 6 months, I don't think it would, we could make as much as $2,190. And the way that this is calculated is by taking the strike price, so $26, you multiply that by 100, so $2,600, and then you're subtracting the $410 that we paid for this option for a total max profit of $2,190. So put options aren't quite like call options where your profits are potentially infinite, but you can still make a crap ton of money if you're right and if the stock does end up going to totally zero. But it doesn't have to go to zero in order for us to make profit. Again, our break even is $21.90, so say if Ford falls from where it's at right now to $20 by June, we would make $190 of profit, which is, again, almost about 50% profit over the next 6 months. The problem with this is if Ford just keeps going up like it is right now for whatever reason you might have, we could lose as much as $410 for this trade. So say we bought 5 of these, we could lose as much as $2,050, which is a lot of money to lose. And that's pretty much how put options work. There's a little bit more detail that goes into buying options, like the Greek values, which I covered in another video. You can go check that out. But something important to keep in mind whenever you're buying options or whenever you're trading options in general is the risks that are associated with them. So let's talk about that. Since buying calls and buying puts is a pretty straightforward strategy, the risks are pretty simple. You don't have to risk early assignment as if you were to sell an option, but you can exercise the option early if you decide to. Generally, it's not advisable since options usually have extrinsic value still tied to them, especially if they have longer until their expiration date and if the current share price for the stock is close to the strike price that you chose. Let's say if you have a deep in the money call option with a week until the expiration date, it's going to have little to no extrinsic value, and sometimes it can make sense to exercise that in order to buy 100 shares of the stock at your strike price. Otherwise, though, you don't want to exercise the option early because you're going to be giving away all of the extrinsic value for your option. So for example, if I pay $1,000 of extrinsic value for an option and I decide to exercise that option the same day, I'd be giving away that $1,000. that basically gets burned into nothing. Exercising an option is basically like letting it expire, and if you have a long time until the expiration date and your option is fairly close to being at the money, you're going to be giving away a lot of extrinsic value. So usually you're not going to want to exercise your option early. Now, the final risk of buying calls and puts, again, is very simple, to where you don't want to put more money than you can afford to lose into a single trade. Since options can ultimately go to zero if they expire out of the money, you have to recognize that. So if I have $10,000 in my total portfolio and I decide to throw that all at a single option, I have to realize that I can lose that entire $10,000 if I'm wrong about the trade and if the option expires out of the money. That $10,000 can go to zero and I might as well have just burned my money. Personally, I've lost as much as $12,000 when my portfolio balance was like $36,000 and I was betting on Tesla going up on battery day, and really I would never make that trade again. Even with an $80,000 portfolio now, I would never put $12,000 towards a single option. The most amount that I'm putting towards options nowadays for a single option is between $1,000 and $2,000. I'm okay with losing a couple grand, but I'm not okay with losing $12,000. That's a lot of money for me right now. Risk tolerance is really going to be up to you and how much you're actually willing to lose, but just realize that whatever you put into an option, you might as well just kiss it goodbye, and if you're right in your trade, then great, you get to make money. But if you're completely wrong in your trade, you could lose everything that you put into it. So that covers the risks of buying options. They're super simple. If I missed something, please let me know. And if you have any questions, just leave them down in the comments. Thanks for making it all the way to the end of this video. And thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.